Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for my best moments of March on Futures Radio Show. Futures Radio is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays, and you can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. To learn about some great offers that these sponsors have for our listeners, please visit futuresradioshow.com/sponsors. All I could say is wow. What can I say about March of 2020 that all of you don't already know? By far the craziest month in markets and in life that I've ever seen. I hope all of you and your families are doing well during this time. I am personally doing well and have made up my mind that I'm coming out of this better mentally and physically when this is all said and done. I have been doing some videos on YouTube from my new studio in my guest bedroom in my house, and hopefully you'll tune in and check out some of those videos. For today's episode, I had a ton of great guests this month, and thank you to all of you that have tuned in during this crazy time in markets and in life, and thank you to all of my guests that joined me this month. My guests have shared a ton of knowledge and thoughts on what's happening in the market, so I put together a compilation of my favorite moments all in one episode for you to enjoy. So without further ado, let me take you right to my favorite moments of March 2020. I went through a lot of your posts and I picked some of the favorite things, my favorite things that you've talked about, and I said that trading is a journey of oneself, and I can relate to so many of the posts that you put out there. And one of the posts that you recently put out, and I loved it, it was how to forgive yourself and let the past go. Because I think that traders struggle with this. I know that I did. I internalized everything. You know, I'm such a competitor and blame myself for everything. You know, you want to do good, and when you're not doing good, you know, you put a lot of weight on yourself, a lot of blame on yourself, and it's hard to let that go. Talk to us about that post of you teaching people how to forgive themselves and letting the past go.
You know, forgiveness is a really important thing to me. I think it is. Well, first, before I talk about what I think, let me talk about my experience with it. It has single-handedly been responsible, I think, for the relationship that I have, like with my mother, you know, because I had to do a lot of forgiving there, and the relationship I have with myself, particularly looking at and reconciling some of the behavior that I engaged in while I was under the influence of alcohol and things of that nature. And I was like, okay, I need to move past these things. I need to live. I can't constantly beat myself up. I can't constantly feel angry when I think about my life coming up and the things that I became more aware of as I got older. So I said, what can I do? And I stumbled upon this book quite by accident in the bookstore about, at this point, one of my favorite, almost 20 years ago, called A Course in Miracles. And The Course in Miracles, the entire premise is, you know, forgiveness is kind of the way to love, and forgiveness will take you to peace and all that kind of stuff. Well, I read that a few times, and I really internalized and started practicing this idea of like willful forgiveness. I didn't want to just wait for time to wash things away, because one thing I've always recognized, and perhaps this is genetic, or maybe someone slipped a book of Stoic ideas to me when I was a child and I don't remember. One thing I always recognized is that you need to have a clear emotional You need to have a clear emotional temperament. Your mind needs to be clear, because the more emotionally volatile you are, the more likely it is you'll make mistakes. And when you make those mistakes, you're gonna have to deal with those consequences, or you're gonna have to deal with like the consequences of those mistakes far after your emotional state is stabilized. In other words, you don't want to do something with permanent repercussions in a temporary mindset. And so I've always been a big fan of keeping a cool head and trying to keep a cool head, but I could not think my way through certain emotional issues, and for that, forgiveness was necessary. And forgiveness, the whole idea is, to give up before you're ready to. I think a lot of times we hold these grudges against ourselves, and we can't let go of the past because we want the books to be balanced, so to speak. When people seek revenge, when people feel guilt, that is a way to go, okay, something can happen that will make what happened in the past even. You took something from me, you're going to give me something back. Or I took something from the world, I got to give something back now, when it's internally directed, the guilt portion. But what forgiveness makes you do, forgiveness makes you go, okay, I'm going to cancel this debt. And when you cancel that debt, then the ledger is clear, and then you can start working on the other things that ledger was keeping me from handling. That's a lot of energy. If you have a grudge against someone, well, what is that all saying? Having a grudge against someone is like swallowing poison and expecting them to die, because they don't know, they don't feel anything. You're the one that carries that poison, and I believe that it is probably more natural to feel that way than it is to not. So you have to come up with some type of strategy, some type of tool to overcome this state, because otherwise your emotional attachment to hurt and your obsession with trying to effectively reverse the past, to undo what happened, will destroy you. You can't think clearly, and I didn't want to destroy myself. It's the same idea behind why I stopped drinking, is because once I recognized the behavior or a trait in myself that was going to lead to me ultimately ruining myself, I said, okay, I need to do something about this. I need to take action. That's the thinking part. My thinking led me to forgiveness, which is an entirely emotional process.
I know that last summer you had a big drawdown. Talk to us about your approach after you have a big drawdown. What is your mindset like in recovering from a big drawdown?
Oof, great question, man. This is, I guess, what's more important that we could talk about today, kind of, right? Because this is ultimately what separates, the boys from the men, so to speak, in I guess, to use a sexist trading term. The first thing that I've learned to do, which is totally counterintuitive for me, against my nature, is to stop trying so damn hard. Okay, so typically, 100% of the time, if I'm not seeing things well and I'm slipping into a drawdown, and something. Look, most traders are in a drawdown most of the time, right? Your last trade was a loss, you're in a drawdown, So what I'm talking about is something that's a little bit removed from your normal variance of P&L, and you're actually getting into a real drawdown. I used to try harder, right? I used to, essentially what drove me was the recency bias of the recent losses. And hey, look, quite frankly, I'm more of a blue collar guy. I'm from Alabama, grew up on a dirt road, and I'm going to outwork you, right? I'm going to come in and I'm going to try hard, and I'm going to never say die. And I have extremely high, almost like cocky kind of self-confidence. So that's another bad thing for trading. And obviously that's not a good recipe. So step one for me is to have painfully learned to don't try harder, don't press more to fix the situation. It is what it is. Now's the time to actually take the foot off the accelerator rather than push it pedal to the metal and try and improve. So that was a long, hard lesson that I had to learn. And secondly, is along the same vein there, is getting back to the basics. And I think this is true in sports. It's certainly a lesson that I took from being a competitive tennis player growing up. When you're not playing well, when it seems like nothing's going your way, it's time to get back to the basics. It's time to stop thinking about the advanced strategy and perhaps various tactics that you're trying to or had planned to deploy in that match. And it's time to get back to watching the way the ball, I kid you not, watch the way it spins as it bounces off the ground, as it's coming to you. Focus on the way it's rotating to make your shot. Focus on having a good, in tennis, you take the racket back and then you swing through. Focus on having a good takeaway. Focus on having great footwork. Focus on a nice follow-through finish on your shots. Focus on a safe cross-court forehand with nice net clearance and trying to get some good depth on your shots. Go back to the fundamentals, the basics of good tennis, rather than, again, trying harder and focusing on more, well, let me hit it harder. Let me hit more winners. Let me try and win this thing because, it's not working. So in trading, what do those things look like, right? What are the basics? Really making sure that you have a good narrative present, that the trade that you're thinking about getting into is backed up by some hypos or if-then scenarios or whatever you call it, that you're prepared to go execute on that day. Make sure that you're not being impulsive when you are making a trade decision, whether that's entry, whether that's moving a stop, whether that's taking some off, whether that's adding. Make sure that you're getting back to being very checklist driven, very process driven in your approach. And I think trading less becomes a part of that. So you're amping up your selectivity, right? I think there's a normal ebb and flow with a lot of traders. With you're doing well, you feel like you can trade more and do more. You trade worse. Now's the time to get a bit more selective. I'm not talking about being afraid to get in because you're afraid of losing anymore, but I'm talking about making sure that if you're putting risk on, it's well worth that risk. It's A+ type opportunities. So slowing down, backing off, getting back to the basics, the fundamentals of good trading for my process, not trying to, get cute here and there, which I allow myself to do at times when I'm trading well. That's the most important things, I think. From there, reducing size, right? And as it was for me, one of the, I guess, step 4 might be going back to the demo for a second. If you're and you've got to know yourself here, and having access to guys like Dr. Steenbarger and coaches and having a risk manager and stuff helps. It's very difficult to do this on your own. But knowing when it's time to say, you know what, just let me go to the demo. Let me just start to build some form of psychological capital. And one thing, and I'm a very process-driven guy. I like to talk about as much as I can, be objective and black and white, tangible stuff. But let me give you one little more subjective type thing here, and just from a mentality perspective. This sounds crazy, and this sounds contradictory to a lot of stuff that you'll hear me say. But I think there's something to this. And in fact, I remember a year ago, one of our very best traders, just phenomenal trader at S&B, a guy we call Shark. And we were at a happy hour having some Lagunitas, and we were talking about drawdowns. In fact, this was during my drawdown. And one of the things that we ended up talking about and kind of sharing and kind of exploring was this mentality around I don't care if I make any money today. This sounds crazy. It's against everything I say, guys. I'm so sorry. But I'm not going to lose money today. I'm not going to lose any money today. And that's like this, I'm just going to be barely green, if anything. And I hate myself for even saying this, but there's some kind of subconscious mental shift that happens when you dig in and you just take that mental approach a bit. And I'll just leave it at that.
Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. Walt, welcome back to the show.
Thanks, Anthony. Glad to be here.
Thank you so much for taking the time to speak with me today. I know you're a very busy man, and you just put out a letter to all of us in the industry talking about the BOCA that wasn't. Let's just start there today. Walt, can you share with us what you wrote in that letter to the futures industry?
Well, it's really a reflection about today would have been the first day of our BOCA conference. And last week we had the very difficult decision to cancel BOCA given the COVID-19 coronavirus. And it just was reflecting on the things that we'll miss from BOCA, but that this was the right decision, that the most important thing, that if people are at their desks doing their jobs, being the stewards of the markets during this volatile time, and our markets are working. I think the piece I sent out was about, we shouldn't be apologetic about our markets. They're actually doing exactly what they were built to do: manage risk, discover prices. And we're trying to, at FIA, support the markets, make sure that the markets have the information to make good decisions, make sure that customers are served. And so really the piece was about, the decision of why we decided to cancel, how it came to be. But the points I would have made had I been in BOCA are as relevant today during the coronavirus as they are, had we not had the coronavirus. So I just wanted to make sure that the members of FI and the participants at BOCA know that we were thinking about them today, but the decision was right, and they're doing the job they should be doing today, which is overseeing the markets.
You mentioned that you shared some points that you would be discussing when you were at BOCA. Every year I look forward to every year you kick off BOCA or every FIA event with a speech. Can you share with us some of those points that you'd be discussing in that speech that you would normally be making?
Well, yes, and I reference, the power of markets. Our markets are sometimes under attack, especially in a political election year. Oftentimes, people who are trading in the markets are attacked for discovering prices that politicians may not like. But my view is that markets are simply like a mirror. They're reflecting supply and demand. They're measuring the temperature and the sediment of the information coming into markets. So I'm tired of being apologetic for markets. We should be strong supporters of markets and making sure that they're efficient, that they have the right information, that they're competitive. And so that would have been a big part of my speech, is making sure that people understand that markets are helping to find solutions. They're not the problem. They're going to be the thing that helps us find solutions to problems in our society. Secondly, and I mentioned this, the importance of thinking about the customers first. We oftentimes get busy, staring at our own navels as an industry. But as I reference in this piece, that Kok Song, one of the founders of our modern derivatives markets out of Singapore, reminds me that we sometimes forget and we get into trouble when we don't remember customers. So, when we remember customers, everything else falls into place, because customers remind us of how we should be doing our business, how we prioritize, making sure that markets are working for their benefit and for the economy as a whole. So that really was going to be a part of it as well. And lastly, the importance of data. Whether it was in my former life as a regulator or today at FIA, I'm obsessed with data. I think data tells us how to make good decisions. It can't always guarantee good decisions, but it can guarantee informed decisions. So at FI, we really, over the last several years, tried to bring more qualitative data to the industry and quantitative data to the industry so that we're able to make better decisions, whether that's regulators, policymakers, or members of our industry. So those three things were going to be a big part of my Boca remarks this week.
I was with 15 traders the other day. We were all sitting down at dinner, and a big part of the conversation was, now a lot has changed in the past week, but I think this conversation is still probably happening amongst a lot of traders and people out there, is coronavirus the trigger that exploited the weakness that we were already going to see in the market? Because in my experience, a lot of times you'll get a headline and that will just be the push that the market needed. Obviously, this is a lot bigger than a push at this point, but is the coronavirus the main reason we are seeing this action in the market?
It's a little bit of both. And I think the way I look at these things is I kind of look at through a Minsky prism. I don't know if your listeners have heard of Hyman Minsky, but he was a famous economist who wrote about, he had the famous phrase, stability breeds or leads to instability. And that is, and we know this from our time in markets, Anthony. You've been around long enough to know this too. We start a cycle with people not taking enough risk because we're afraid. And no one wants to take liquidity risk, committing to an asset for an extended period of time. And we end the cycle with everybody wanting to commit. And this happens irrespective of Fed policy, happens irrespective of fiscal policy. It's just human nature, right? Everyone thinks that low interest rates trigger risk taking. They certainly don't hurt it, but what really triggers risk taking, and we've seen this time and time again, is one, do you feel secure in your situation? Do you feel safe to step out and take some risk? And two, do you see people around you making money, right? I mean, this is why in the financial crisis in 2008, we saw crazy lending going on in 2006 and 2007 when the Fed funds rate was already at 5.25%. It wasn't the price of money. It's because it's because Merrill Lynch saw Goldman Sachs making money and wanted to make the same loans, and they did it more aggressively. It's because my buddy, who I grew up with, saw people who he thought weren't as smart as him taking leverage bets on housing, and he said, I'm going to do it more aggressively because I'm smarter than they are, and got levered up with neg am loans, right? Yep. So that's the big process. So we've been in this thing for 10 years, and little by little, layers of risk get built into the system. And so the way I look at it, when we started the process in 2010, 2011, the punchline I was using is when people said, aren't we going to have another recession? Aren't you worried? Aren't we going to have Lehman 2? I said, you can't commit suicide jumping out of the basement window. And with every passing year, we go a couple floors higher in the building as we get back to normal risk taking, and the pendulum swings into excessive risk taking. Now, the further you are in that pendulum from no risk taking to excessive risk taking, the smaller the trigger need be to get you to unwind. So you would need something massive in 2011, say, or just pick a time, a much bigger shock to get the same kind of sell-off that you could get today after risk has been quietly building for a number of years. I think that natural process, that Minskian process, is the bulk of the reason why we're seeing this. And the coronavirus is clearly big enough a trigger to get that to unwind. So rather than, a lot of guys have been saying, oh, this is just a Fed-induced artificial stimulus and it's all going to come crashing down. It's going to end badly. Every cycle ends badly, irrespective of the policy stance. It's just our nature. And it's a miracle, really, that this, not a miracle, but it's kind of impressive that the cycle has lasted so long. In part, that's because people had PTSD from the last crisis and were slow to take on risk the way they might have been in a previous cycle. But a lot of that, I think the policy responses have been on the whole pretty good. So it was going to happen sooner or later. And the further and the longer you go, the smaller a trigger you need to get this thing to, get the avalanche to kind of, start rolling. And I think this has done that. The risk cycle now, you can say, is over.
Yeah, I mean, every breakup ends badly. I mean, it's just reality, right?
Right.
A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com. I want to move on and talk about something else that you tweeted, and you said literally everything I'm hearing from people trading munis, MBS, CMBS, commercial paper, credit suggests that things are as bad as they can get, and nothing is going to change until two things you wrote. The Fed block bids stuff in size, and two, PDCF gets full capital and leverage requirement relief.
Yeah, so right now in fixed income markets, and credit markets is probably the easiest way to say it. It's not just credit because it's taking place in places that aren't really considered credit in certain spheres. So for instance, mortgage-backed security pools. It's as simple as mortgage bonds get. It's a pool of mortgages that pays out over 30 years. It gets bid relative to bonds because it's a interest rate product. It's fully guaranteed by the government in terms of principal and interest. It's a pool of loans. So those today we're trading 180 basis points over treasuries. So almost 2 percentage points over treasuries. For context, they usually trade 50 basis points over treasuries, something like that. I mean, they trade in a range, but 50 basis points would be a more normal spread for something like that. Commercial paper issued by the highest quality issuers. So we're talking, AA or at worst single A rated issuers in terms of long-term debt, short-term A1, P1, top of the cream of the crop in terms of quality of credit, issuing 30-day commercial paper. And that, 30-day commercial paper from those issuers is yielding 2 percentage points over treasuries, almost 2 percentage points over treasuries. That just, those are two examples of markets that are just broken. Like that is not a sort of informed view on the outlook for some asset, like the outlook for cash flows, the probability of good or bad things happening in the economy, whatever. It's not based on anything like that. It's just pure supply and demand panic selling and nobody there to buy in products that don't carry substantial credit risk, that aren't, this is not something where, they might not make the payment. No, it's not. That's not what you're worried about. There's just no one to buy. And the reason for that is because of flows within the fund system, both exchange traded products, so ETFs, fixed income ETFs, exchange traded notes, leveraged exchange traded notes in particular have been a problem this week. And also just withdrawals, general withdrawals and demands for liquidity in stuff like money market funds. I'm getting color from people who trade short-term municipal debt for money market funds who are, saying this is like, there's just no bid. Like you just can't sell anything. And the reason you can't sell anything is because everyone's trying to sell something. This is not purely a function of ETFs. It's not purely a function of dealers carrying less inventory. It's not purely a function of any one fact. It's just everyone's rushing for the exits at once. And even paper that is money good, that you do not need to worry about a default on, you just can't sell. And I mean, we even saw it in treasuries, honestly, over the past week. So we're recording this Thursday, March 19th, and yields dropped today, but man, they had been going up for a week in aggressive fashion. And so the solution to this, in my opinion, and talking to people that are in these markets, treasuries, MBS, munis, across the board, the solution is twofold. The first thing that can be done is the Fed needs to start buying like in size and now. They need to start taking treasuries off the balance sheets of dealers and replacing them with reserves. So when the Fed is buying, they're conducting an asset swap. treasuries or mortgage-backed securities that they buy goes off of the private sector's balance sheet and onto the Fed's balance sheet. In return, the private sector is given reserves, which are essentially the most liquid and safest possible income-generating asset you can own. They are only able to be held by banks. Banks must mathematically, because they're giving cash to whoever originally owned the treasuries, bank deposits rise when reserves rise when the Fed conducts QE. So basically what you're doing is you're taking intermediated by banks, treasuries from private sector non-banks. Those go to banks. The non-banks get a deposit. The banks then forward on the treasuries to dealers and get a reserve credit for the treasuries. The dealers take the treasuries, hand them to the Fed, and get a reserve credit from the Fed. So it's this flow of asset swaps. And what it's doing is it's taking risk off of balance sheets. It's de-risking balance sheets. And so the Fed needs to do that. And the reason they need to do that is not because it'll have a huge economic impact directly, but because with fewer treasuries and mortgage-backed securities on their balance sheets, these institutions that facilitate liquidity in all sorts of different fixed income products, not just treasuries and mortgage-backed securities, all sorts of fixed income products, they will be able to then say, okay, we can take these reserves. Our balance sheet has gone down in aggregate size because we've sold on treasuries and mortgage-backed securities. We can now go make markets and provide warehouse capabilities to other securities. And so that's the logic behind the QE side of the two things you identified from my tweet. The other side of it is the primary dealer credit facility. So basically, earlier this week, the Fed said any primary dealer, so that's folks that participate in treasury auctions, primary dealers can come to us and post investment grade collateral as well as a range of other stuff that's higher quality than that to this new facility we're creating. We will then offer a loan to the primary dealer based on that collateral. We'll haircut the collateral. So for instance, if it's an investment grade bond, maybe they'll haircut it 10%. I don't know, something like that. And so then we posted an investment grade government or investment grade bond. We get back 90 cents on the dollar in cash. We pay a 25 basis point interest rate on that, and we can go put that cash to work doing something else. So basically, the Fed is offering to fund dealer balance sheets. It's offering to provide the cash necessary for these dealers to own bonds. The problem is that these dealers aren't constrained by funding markets particularly. Funding markets in terms of repo and in terms of short-term credit funding, wholesale funding, so commercial paper, for instance, has been rough, but that's not really the constraint for them. The constraint is their ability to transact and hold these assets without incurring massive capital cost in terms of regulation. So basically, when you hold a bond on your balance sheet instead of cash, it's given a much harsher capital treatment. You have to hold more equity capital against it. You have to have more dollars of equity capital for every dollar of investment grade government bond or investment grade bond that you hold on your balance sheet than if you were to just have that asset in cash instead of the bond. So basically, dealers are unable to transact in these sort of markets because they're unable to hold an inventory of securities in these markets because the capital cost of those securities is too high. This is not a full explanation of all the volatility we've seen, but it would help enormously if when dealers bought a bond from a customer, they could post it to the Fed and be able to fund it, as currently is the case with the primary dealer credit facility, but not incur a capital cost on that bond, right? So instead of basically what the Fed could do, and they've already done this with commercial paper because of a different facility they opened this week. What the Fed could do is they could say, if you post a bond to our credit facility, that is no longer part of your risk-weighted assets calculation. It's assumed that you're good, that our haircut is sufficient, and that we don't have to worry about the value of that bond on your balance sheet. Obviously, this would be controversial, but to me, it's a very good option to free up liquidity and get people trading bonds again and get people trading bonds again at realistic prices that can then be arbitraged towards fair value by the presence of this very cheap funding and without the artificial constraint, essentially imposed constraint of capital costs related to the minimum capital that dealers have to hold against the various bonds they hold in their balance sheet.
Okay, a couple of things. First,
that was long. I'm sorry. That was
no problem. No problem. I mean, I'm learning so much, and I'm the first to admit this is above my pay grade, and I've learned a lot from what you had just said. And my thoughts are, as somebody who trades Treasury futures, from what a lot of what you're saying to me is the reason why we're seeing the lack of liquidity in bond and Treasury futures.
For sure. I mean, look, like Treasury futures have to be held in line, right, with the fair value of the underlying, right? So how does a Treasury future work? A Treasury future is, the way it works on maturity is that a bond is delivered against the obligation of the future. If I'm short the future into expiration, then I have to come up with a bond to deliver into the future. And obviously that bond doesn't have to be any specific QSIP. It doesn't have to be the current on-the-run Treasury for the TY contract. It's whatever's the cheapest bond to deliver in, which is based on a coupon calculation that's kind of over the head of almost everyone that doesn't do this for a living. But basically, like there's a mechanism that anchors the Treasury future to the actual Treasury bond, right? That requires arbitrageurs. Right? You have to have somebody that's willing to buy the bond and sell the future, or sell the future and buy the bond when those get out of line. And when they get unhinged and nobody has the balance sheet to be able to do that, then things are going to get pretty messy. And that's absolutely, we're totally seeing that. In addition to just the fact that, transacting risk is always going to require paying a bid-ask spread. And that bid-ask spread has widened naturally, but also you've got massive problems with people trying to arbitrage treasuries towards their fair value in futures and cash across the entire fixed income market right now.
Today, I'd like to just kick it off with talking about the central bank action. So much has happened, right? I mean, I'm somebody who likes to always listen to everything that's going on and just really develop a theme. And what's going on right now is it's overwhelming. I mean, there's just so many things that are happening. And I'm really curious to hear from you. Just basically give us a recap of what the central banks have done thus far. And maybe tell us what is left in the tank after this, if maybe this doesn't work out the way that they think.
Yeah, I mean, central banks have definitely gone wild. I mean, I think they learned their lesson from 2008, 2009 that you have to kind of hit it hard, and they're definitely doing that. I'll focus on the Fed, but quite frankly, everything I'm going to describe, it's like global now. Like every central bank is basically performing some version of QE. The Fed basically perfected what the Bank of Japan created multiple decades ago. QE. You've had the Bank of Canada that's joined, RBA, down in Australia. I mean, everyone's doing a version of bond buying, but nobody beats the Fed at QE. So we'll go into QE in a second. But before they got to QE, they basically have relaunched all of their global financial crisis era tools. I mean, the alphabet soup of all these different liquidity warehouses, which are really meant to kind of help with market function and prevent like a shortfall in liquidity. They've relaunched all of them and then some. They've slashed rates down to zero. In many ways, I start to wonder, was like 2008 a trial run for what they're doing now? Because they were so much better at it this time than they were, in that crisis. And then, if you look at the real new bazookas, is that they're doing QE at a speed and a size that, I mean, it's just unheard of. I mean, there were, the Fed's balance sheet last week, I mean, not just the bond buying, but just in general, went up $600 billion. I mean, we hear billions and trillions getting thrown around now a lot lately, and it kind of start to like lose track of what those numbers mean. But basically, the buying that they did in roughly in a week or so was equivalent to what they did during QE2, and we were impressed back then by all that buying. So something's definitely going on. They're doing an encore to the old QEs and just doing more of that. They've also now created a program that allows support for the credit market, which is going to be important, and to see how that works out. But with all these things though, and I think what we're starting to realize, and the Fed even themselves are starting to realize, there's unintended consequences. I mean, this is you don't just do this lightly. I mean, they're really trying to keep market function going. But sometimes when you flood it too much, you can like flood the engine and stall out. And I think that they're worried about that. And then I guess what's left, I mean, there's a number of things that they can still do. But I think this is, the current crisis is a health crisis. We have to kind of acknowledge that and face the reality that until the numbers improve and things get better on that front, what they're doing is just buying time, these central banks and fiscal action. But what they could do and what's left, I mean, I really hope that they do not buy equities, and that they can manage with all this liquidity to provide some stability. And we kind of we look forward, and we still have one area of capitalism that's fully functioning on the equity side. They could peg rates like Japan has been doing, like you kind of anchor rates. I'm not a fan of that either, but it's within their wheelhouse to actually lock in rates to help the government fund all these programs so that we can kind of get to the other side. Probably support munis. I mean, there's some news over the last couple of days that the Fed has hired a muni banker. Okay, so maybe they're going to support the muni market. That's an important part of the fixed income market too. And then then he starts to really go down the rabbit hole, and it starts to get into the more evil tools, which I don't really like, which is like negative rates, forcing bail-ins on banks. It starts to get really ugly over there. So I'm gonna, but that's a moment where you have to cover your kids' ears. You don't want to hear that. And I think that's basically it. I think we're at that juncture where they've done a lot, and there's a few more tools left, but they start to get really into areas where I think they don't want to go.
So a few thoughts after hearing you give a recap. One thing that really stuck out to me in what you had just talked about was you said they got better at it. They're better at this. Could you go into a little bit more details of why you think that they're doing a better job now than in the past?
Well, I mean, I think that they've been preemptive all along, even prior to this, by doing the insurance easings that they did last year. They learned through which I didn't go into, but it's also part of their toolbox. The repo debacle that we saw all throughout the fourth quarter of last year and the early part of this year before we got into this downdraft. They've learned the pressure points in the system, and they're trying to really fine tune it and hit it harder than before. So, I mean, you have to applaud them for that. But with everything, there's a certain threshold, I think, that where even folks like myself would say, hey, like you're going a little bit too far. You don't want to become the market. You want to allow market forces to kind of work their way through. But I mean, they've basically have their hands on like the dike, holding, to make sure the water doesn't kind of come through. They have basically the dam holding back the dam in a way that they've never done before.
What were your thoughts on the market's reactions after some of the things the Fed has done?
The thing is, especially how vol's been trading and what, on the one hand, you have like central bank support, which for nearly a decade, there's been a whole generation of traders that have assumed that central banks got my back, therefore that things will always snap back very quickly. And so I think what really surprised and caught people off guard was that even with these unprecedented actions, the speed of how they've kind of tackled some of these issues, you still had vol pretty elevated, and pockets of even the more liquid markets like treasuries not acting like they usually do. And so the market I think took that in shock, and the easiest answer, especially like the broader markets like the stock market, was to sell, because if you're seeing things that should work and they're not working, your gut reaction is, hey, I got to de-risk and and really try to figure out what's going on here. I think with time and the amount of what's been thrown at this thing, they'll get their arms around it soon enough. Treasury vol has been coming down. We still have elevated VIX, but we're seeing it start to percolate through. But they need to go big, because these are very imprecise tools to begin with, right? I mean, there's some pipes are clogged somewhere, and they're trying to flood it and hoping that it just kind of breaks free that logjam to kind of get towards the financial actors that need that help.
Hey everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.